Hello everyone, my name is Nader and today we will talk about the income statement. So together we will understand what is the income statement, what is the component of the income statement, what is the financial ratios that you need to know to understand what is the number in the financial statement or in the income statement. So let's start. So in the beginning we will start by understanding what is the income statement. So the income statement is the statement that it will give you the profit incurred or the loss incurred during period of time. This time could be a month, could be half year, could be a year. So by subtracting the expenses from revenue, it it display the net income or loss, indicating the company profitability during time. It breaks the total sales revenue and expenses involved, providing insights into operation efficiency. So by having the income statement, of course, you need to compare the income statement with the previous income statement from the previous period, or you can compare it with the industry average, or you compare it with the budget income statement that you have. This will help you to understand the profitability, the potential issue that need your attention, and also the so what is the component of the income statement. So first you will find the total sales minus the cost of goods sold or COGS equal the gross profit or gross margin minus the depreciation expenses minus selling and administrative expenses. It will give you the EBIT or earning before interest and taxes minus the interest expenses equal to EBT or earning before taxes minus taxes. It will give you the net income. You will always find this component in this set. So at first you will find the sales, you will find the cost of goods sold, you will find the depreciation, interest expenses. You will never find the sales minus taxes. It will never happen. So these are the example of the component of the income statement. So now we will understand each component of the income statement. And of course, we will start with the sales. So what is the sales? So the sales represent the overall income from selling goods or services before any deduction, before deducting the cost of goods sold, before deducting the salary, before deducting the rent, for any deduction. So it will give you a basis for the profitability analysis. The next component is the cost of goods sold, which is the direct expenses of the productions. It could have the raw material, the direct labor, and the overhead for the product or for the service that you sold. So if we subtract the sales from the cost of goods sold, we will reach to the gross profit or gross margin, which is the key metric showing how efficiently a company produce and sell its product. So after the gross profit or gross margin, we need to deduct two important components, which is the depreciation and selling and administrative expenses. So you need to understand that the depreciation, it's not out of pocket money. It's not real money you expense it. However, it's represent the allocation of the cost of the fixed assets that you purchased before. So for example, let's say that you got a machine for your factory. This machine costs 100K and this machine will last for 5 years. So for accrual basis financial statement, you cannot deduct the full 100K in the first year or in the time that you purchase. However, you need to allocate this 100K for the time that you will use the machine, which is the 5 years. So again, the depreciation, it's not out of pocket money. However, it's part of the income statement. So the depreciation, which is spread the cost of tangible assets over their useful life, impacting net income and reflecting assets aging or expansion. And after that, you will deduct the selling and administration expenses, which is include the salaries, the marketing fees, administrative costs essential for running the daily business activities. So now we understand the income statement. We know what is the component of income statement. We understand each and every component. So let's go to the key financial ratio that we need to know. How we can read the income statement, how we can read the numbers there. So first thing, it's the gross profit percentage. I know that the gross profit is the sales minus the cost of goods sold. So what is the gross profit percentage? It's the gross profit divided by sales. It's measure the profitability related to sales. A higher percentage than industry average will indicate strong pricing and effective cost control. Of course, if you are in a competitive market and you can produce a product for $1 and all of the competitors they are producing for $2, so it means that you have a strong cost control. Second is the depreciation expenses trend. Again, as we said that depreciation, it's not out of money or out of pocket money. However, it spread the cost of the fixed assets during the useful time. So changing in the depreciation expenses between period to period, it will indicate assets acquisition or disposal, which impacting the profitability. EBIT, which earning before interest and taxes versus the interest expenses. So what is the relation between these two? Interest expenses represent short-term obligation and EBIT represent the money that you have after deducting the cost of goods sold and also after deducting the depreciation and sales and administrative expenses. So this is the money left so you can pay the short-term obligation. And the last part is comparing with the past and other financial statements. So reviewing previous periods budget and balance sheet provide comprehensive understanding of financial stability and performance. So these all about the income statements. Again, in the next video, we will try to link the balance sheet with the income statement. We will try to understand what is the numbers related to each others and how to read both statements together. So it will help us to understand the financial stability of the company or the financial health of the company more efficiently and effectively. So thank you for watching and see you in the next video.